Stock market returns are like gaining weight. The big gains happen over just a few days. Credit to Philip Perlman for coming up with this analogy. So research has shown that the average person gains 1 to 2 pounds per year from early adulthood through middle age. But this weight gain isn't distributed evenly throughout the year. According to a study that tracked subjects in the US, Germany, and Japan, people tend to lose a little bit of weight every day for most of the year. But once the holidays roll around, that reverses and people tend to gain weight really fast. Take a look at this chart. You can see that people go from losing weight on average to gaining weight on average around Christmas and New Year. That kind of makes sense. In the winter and especially the holidays, it's cold, people stay inside, they move around less, and they eat more. So what Philip argues is you should be conscientious of this. It doesn't mean that you shouldn't enjoy the holidays. It just means that you should be mindful that it's around this time of the year that people have unhealthier habits when it comes to food and exercise. So how does this relate to investing? Well, there's a similar pattern in investing. Most of the big gains in the stock market tend to happen in just a handful of days. Over the past 4 decades, if you missed just the 5 best days in the market, you'd have 38% less money than if you stayed fully invested. If you missed the 30 best days, you'd have 84% less money. That's why it's so important to stay invested through thick and thin. If you miss just a few of the really big up days in the market, your returns will suffer enormously. So this is a pretty interesting analogy. Big gains in both the stock market and our waistlines tend to happen over just a handful of days. But of course, the takeaway is different. When it comes to stocks, you want to capture those big gains, but when it comes to weight, you usually want to avoid the big gains. Hope that helps, and subscribe for more investing insights.